I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets.
The link between volatility and time is an advantage of long-term investing. Longer-term investments have lower volatility than shorter-term investments. The more you invest, the more inclined you are to survive market downtrends. In this video, we'll talk about Charlie Munger's approach to long-term investing, so make sure you stay tuned until the very end to find out. Charlie Munger, born 1924, is Warren Buffett's vice chair and second-in-command at Berkshire Hathaway, a $354.6 billion diversified company headquartered in Omaha, Nebraska. Munger has been Berkshire Hathaway's closest business partner and right-hand man for over 4 decades, helping the company grow into a massive, diversified holding company with a market capitalization of over $700 billion as of February 2022 and subsidiaries in insurance, freight, rail transportation, energy generation, distribution, manufacturing, and retail. Munger is chair of the board of Daily Journal Corporation, a Los Angeles-based legal publisher with a software industry in the automated court reporting sector, in addition to serving as an independent director of Costco Wholesale Corporation. He was the chairman and CEO of Westco Financial Corporation, a Berkshire Hathaway subsidiary, from 1984 until 2011. Munger, who was born in Omaha in 1924, worked as a youngster at Buffett & Son, Warren Buffett's grandfather's grocery store. He enrolled at the University of Michigan to study mathematics during the World War I, but dropped out a few days after his 19th birthday in 1943 to join the United States Army Air Corps, where he was trained as a meteorologist and advanced to second lieutenant. Later, he continued his meteorology studies at Caltech in Pasadena, California, where he called home for the rest of his life. He entered Harvard Law School without an undergrad degree and received a JD magna cum laude in 1948. He created Munger, Tolles & Olson, a prominent California law firm, as a real estate attorney in those early years. Munger and Buffett met at a dinner in Omaha in 1959 and stayed in touch over the years as Buffett built his investing firm and Munger continued to practice real estate law. Munger gave up practicing law in the 1960s to focus on investment management, including a real estate development partnership with billionaire newspaper executive Franklin Otis Booth on Buffett's suggestion. Prior to joining Berkshire, Munger had his own investment firm which, as his friend Warren Buffett pointed out in his 1984 article, The Super Investors of Graham and Doddsville, achieved compounded annualized returns of 19.8% between 1962 and 1975, considerably outpacing the Dow's yearly growth rate of 5%. Buffett began buying Berkshire Hathaway stock in 1962, and by 1965, he had gained control of the corporation as chairman and CEO. Munger became vice chair of Berkshire Hathaway in 1978. Buffett has always been a value investor, constantly seeking out and evaluating firms that are trading at a discount to their true value, a practice he acquired from his guru, Benjamin Graham. Buffett cited Munger with correcting him in his 1989 letter to shareholders, stating that Berkshire should not chase the cigar butt version of value investing, which refers to investors who acquire a failing business worth $1 for 75 cents merely to grab the 25 cents of free puff that's left in the business. According to Buffett, he began his career as a cigar butt investor, and Munger recognized the folly of that strategy long before he did. Charlie grasped this early. I was a slow learner. Working with Munger, he discovered that a low price for a struggling business with several defects was typically a deceptive discount in the end, and any instant benefit would be quickly destroyed by low returns. Munger and Buffett, on the other hand, would rather acquire a fantastic business for $1.25 when it's today worth $1, but would undoubtedly be worth $15 in 10 years. In other words, adopting Munger's credo, forget everything you know about buying fair businesses at great prices. Instead, purchase amazing businesses at wonderful prices. The Berkshire version of value investing proved incredibly successful. According to Forbes, Munger has a personal fortune of $2.5 billion as of 2022. Charlie Munger, like many others, is a value investor who believes that anyone who follows this strategy is a smart investor. Munger, on the other hand, had a quite different perspective on value investment than Buffett. Warren Buffett, Munger's friend and business partner, modified his investment strategy as a result of Munger's influence, as his wife persuaded him to search for exceptional firms at a reasonable price. This refers to organizations that have a high worth and the ability to retain and expand that value over time. but are also experiencing transitory difficulties that have led their share price to drop. The following corresponds to Berkshire Hathaway's investment philosophy. Yet, Munger has identified himself as an opponent of excessive diversity as an additional tactic. At Wesco, he runs a focused portfolio of only 4 equities. To illustrate this, Munger justifies his method by claiming that if you understand the business, and thus the risks and opportunities, a specialized portfolio will outperform a fully diversified portfolio over time. Munger is known for his candor as well as his investment acumen. During a Q&A session at a 2021 shareholder meeting, when Buffett diplomatically evaded concerns regarding cryptocurrency, Munger plainly stated that Bitcoin was made out of thin air and is a go-to payment method for crooks. He was disturbed that someone just invented a new financial asset out of thin air was receiving billions of dollars. He also welcomed China's cryptocurrency ban while criticizing the United States' strong involvement in the currency. Munger's charity focuses on education with substantial donations to the University of Michigan Law School, $3 million in 2007 for lighting improvements and $20 million in 2011 for housing repairs. In 2004, he donated $43.5 million in Berkshire Hathaway stock to establish a graduate student housing complex at Stanford University, and in 2016, he donated $200 million to the University of California, Santa Barbara for state-of-the-art student housing. Munger has been essential in the building of Berkshire into a gigantic holding company with a market value of $700 billion as Buffett's right-hand man. As vice chair, Munger is in charge of all assets, including what Buffett refers to as Berkshire's 4 giants, the 4 investments that make up the majority of the company's value: 1. Insurance float from subsidiary insurance businesses; 2. Apple Incorporated; 3. BNSF, Burlington Northern Santa Fe Corporation; 4. BHE, Burlington Highlands Electric; Berkshire Hathaway Energy. Munger is credited with ensuring that Berkshire value investing followed Munger's mantra: forget everything you know about buying fair firms at fantastic prices. Instead, purchase amazing businesses at wonderful prices, according to Buffett. High ethical standards are key to Munger's philosophy and his success. Munger claims that if he acquired one talent, it was playing cards, because this is where you learn to fold when the odds are stacked against you and to seize opportunities when they arise. He is one of the world's wealthiest men because he can lead by example. He's an ambitious and a quiet man who enjoys architecture and research. Charlie Munger is a role model to emulate, with a tale that may teach us key skills like endurance and how to make rational judgments. Forgetting your failures is a terrible blunder if you're attempting to develop your intellect, Munger observed at one point. Why not make a day of it? This may be shown if you look at Berkshire's IT investment history. Berkshire did not invest in technology for a long time because Buffett and Munger believed that they did not understand it quite well. This was the correct mindset to have during tech's illogical late 1990s bubble and subsequent recession. However, they eventually realized that technology had evolved into a dominating consumer industry and that they should have paid enough attention from the moment Google captured their interest in 2004. Many investors, regardless of their size, would rationalize their actions and claim that they were the correct thing to do. Buffett and Munger, on the other hand, did not do so. They not only admitted their error, but they also remedied it by making a large investment in Apple. Furthermore, they publicly acknowledged the error and accepted questions about it at their annual shareholder meeting. As a result, their corporation and its stockholders have made smarter and more successful investments. Of course, as a typical of Munger's statements, they are more life lessons than financial lessons. Everyone makes errors, and most of us have a hard time admitting that we were mistaken. You can see that every day if you look around at what's going on in the world. Investing errors, on the other hand, are something we can discreetly acknowledge to ourselves and correct. We can not only correct them, but we can also ensure that we learn from them, paving the road for improved returns in the future. Consider the market panic of March and April of last year. Was that a blunder? It didn't appear to be that way at the moment. The most critical question is, did we learn anything? So that brings us to the end for this video. Thanks for watching. If you enjoyed it, please like, share and subscribe to our channel for more such great content.